I'd like to start by discussing the significance of the topic, and for all of us involved in real estate and investment, whether we're working for a sovereign wealth fund or whether we're working for a real estate developer, we all now have to face that the elephant in the room, so far as real estate development and real estate investment is concerned, is the whole question of land. Time was in the 1990s and years before, and I've heard this said by professionals who were working in European development, for example, at the time, that if you had to spend more than 25% of the total value of a development project on your land, then it was a fairly good indicator that your project wasn't going to be successful. I think it's fair to say that in our region, anybody who is fortunate enough to spend 25% of their costs on land is either the beneficiary of free land, which I'll come to later, or they're operating in the most extraordinary rural environment in some particular location, or they simply haven't done their sums right. The fact is that for all of us, land is an incredibly important part of our development costs now. One of the most extreme examples that I've come across is Kuwait, where as a result of certain restrictions on the availability of land, some of which have been eased shortly and reasonably, but most of which continue to prevail, there is an amazing shortage of land, and reports from KFH and so forth indicate that we could be paying up to an amazing 80% of our total costs of development for land. And in the case of central Kuwait, it's generally accepted that the consequence of this has been that land prices make development almost prohibitive, and it doesn't become a very sensible investment opportunity. In Abu Dhabi or Dubai or London or Paris or Moscow, we've seen the percentages rise from 30, 40% in the 1990s up to 50, 60, 70%. And all the evidence I've got is to suggest that those percentages are going to continue to rise. In fact, and you can go onto YouTube and see this remarkable video of a hotel being put up in 48 hours. In general, the cost of infrastructure, and by that I mean utilities and so forth, but also buildings themselves, construction cost of buildings, is reducing whilst the cost of land as a proportion is increasing. And this trend, I suggest, is likely to continue. The problem with all of this is that the valuation of cash-generating assets is much easier than the valuation of assets that don't generate cash, especially if those assets are not one single homogeneous metal, for example. The most obvious example for a non-cash generating asset that has value is, of course, gold, but there are a number of others. Nice and homogeneous. But of course, land is not like that. It generates significant problems for us in terms of its valuation. But at the same time, a real estate developer, a real estate investor, have to look to land increasingly as the source of their profits, the source of their value. And what that means is that we can no longer ignore questions of land valuation in our financial modeling for development and for investment. I think probably fair to say that given the time frame under which developers operate, and by development I mean constructing and selling buildings and the land associated with them, the problem of land valuation is intrinsically less for developers than it is for investors, simply because the time frame under which they're operating means that they have to acquire, or at the very least account for, if they've been given it free by government, the market value of land, and then sell it on as part of their development within an 18-month period. So provided that the land increase in value at least keeps pace over an 18-month period with the developer's required internal rate of return, they can more or less not worry about the land to such a degree. Though finding the finance to acquire it, of course, may be a very significant issue. The other thing from a developer standpoint, of course, is that a number of developers, and the UK house builders are a very good example of this, but also firms like Istisma in the past and Akil and so forth, have all acquired significant land banks. And part of the valuation of organizations like Emaar and so forth and Akil have been the land banks that they possess, and they're possessing them over a long period of time. And land forms, because it's important, the question of how much that land is worth forms a significant element of our analysis of the valuation of these organizations as a whole. So that paints a picture, I think, of why the question of land matters, and it matters probably in this region more than anywhere else because such a significant portion of our investments are in real estate. So that's why it matters. So the next question is how we go about doing the job. Well, traditionally, in the past, the way it would work is that we would analyze a patch of land according to highest and best use. And we still do this. There's nothing invalid about the highest and best use principle. We say, what would we best use this land for? Would we best use this for a hotel? Would we best use this for an office block, residential, mixed use, whatever it happens to be? We then carry out a discounted cash flow analysis, ideally, but we could shortcut this by using cap rates. And we come up to a total value of the investment. Now, because the cash flow generating asset, the building, the improvement, can be calculated in terms of its value according to Best Royal Institute of Chartered Surveyors methodology by using a discounted cash flow, and without wanting to get into the intricacies of how you calculate discounted cash flow for income-producing assets like buildings. Essentially, we can calculate the discounted cash flow, the net present value of the net operating incomes of the cash-generating assets, and call that X, whatever it happens to be. We then know what the total value of the asset is when we sell it to the purchaser. And by subtracting that X from the total value that we sell it, we obtain a residual, which is the land value. Now, this residual method of land valuation has been used for many, many years, and it's still applicable in places like the United States and elsewhere, rural environments or semi-rural environments, suburban environments, where we can be reasonably sure that the predominant element of the value of a building being sold is the cash flow that it's generating. But as we move to an environment in which it's the building that's the residual rather than the land, the accuracy of a residual method of land valuation calculation inevitably declines. And I would certainly caution anybody in this region from using the residual method of land valuation unless you can be very, very sure that you're dealing with a percentage which is, say, under 40% of the total. Now, in jurisdictions that have tax, what often happens is that there are indices used on land valuation where land is sometimes priced at historic values which have very little to do with current market prices, and the escalation on the value of land is carried out on the basis of, for example, inflation rates or occasional surveys of the market, or any other, even a fixed percentage every year. And the result of this, of course, is that in many cases the tax calculations, and speaking as a small landowner in Australia myself, the tax calculations that are used for the value of land are often way off beam in terms of where we are with actual market values, which are more volatile, and the values are often higher than anything which is used for tax calculations or registration purposes. So again, I would certainly caution against using any tax-based method for the process of analysing current market valuations of land. Obviously, of course, one minor point, but the size and the topography and any potential environmental damage and any other issues were also all vitally involved in the question of the valuation of land, and the question of size is not always linear. So, for example, in Australia, where you have a minimum land size in certain jurisdictions, a minimum lot size, minimum registration size of 5 acres, which is quite a considerable size in the suburbs. If you possess 10 acres, then you have the capacity to subdivide into 2. If you've got 6, then you've only got 1, and effectively you have no subdivision abilities, and therefore the value of land tends to go up not linearly, but in 5-acre jumps. So your valuation goes from 0 to 5, and then from 5 to 10, and so on and so forth. And in inner city environments, that may well be reduced to 1/4 of an acre, or so many 2,000, 4,000, whatever it happens to be, meters squared. So the size of the land parcel is one issue. The other issue, of course, that one needs to consider in land valuation, just to sort of assemble the ammunition for all of this process, is what externalities and other appurtenances may exist on the land, in particular questions of easements. So land, for example, over which there is a right of way from external traffic or otherwise might be less valuable than land which does not. And by introducing this, I'm raising the question right at the start of this process of the characteristics that the land possesses, key characteristics which will drive its value, not just the size of the land parcel, but the qualitative aspects of the land, its attractiveness for valuation purposes. I'm reminded very much when I talk about this in seminars with a very good presentation which I saw on UK land, which talked about the increase in value of land as certain characteristics of that land were changed. And out there you've got the difference between, and it's an obscure difference for us living in an urban environment, but you look at the difference between pasture land and grazing land. And you might think there's no difference between them at all, but in fact there's a tenfold difference depending on the difference. And when you start adding utilities into a land, and when you start adding sheds and shelter for livestock and so forth, you can have a very significant difference in value. The other thing, of course, that dominates land valuation, and has always done, is location. Distance from the central business district, distance from traffic hubs, distance from transport hubs, from facilities and so forth, will all be a vital interest in calculating and looking at the value of land. And what this means is that any good land valuation exercise is data and quality hungry. We need to find out as much as possible about the individual land before we go ahead and start talking about how we're actually going to go about valuing that land. And we're doing so as part of a valuation process on a big business, or as part of an investment opportunity, or as part of a development opportunity. We need to get an accurate figure on what that land valuation actually is. So that's how it was done traditionally. How do we do it now? This is the core of my presentation here. If you look at the whole question of valuation, not just of land, but of anything, the way you go about valuing anything has to be done essentially through one of 3 different ways. We really haven't invented much of an alternative to those 3 ways. We've had one modification with it, but only a small modification. The first method that we can use to value something is through discounted cash flow itself. And as I mentioned, income-generating property is well suited to a cash flow valuation method because you've got the cash, you've got the time period over which the cash is going to be delivered, and depending on risks and depending on a number of other factors, you can move from that to a very good idea about how much people will pay for that cash flow. And bonds are in the same category, and a number of other things, ships, aeroplanes, a number of other assets and so forth, get fitted into that same category. However, discounted cash flow
is really only suitable for those assets where you do generate cash. Now, somebody might say, well, you do get cash from land. Agricultural land is rentable by farmers, after all, and even land in an urban environment could be rented by somebody for a car park or some other purpose which they might want to get hold of the land. Well, I think it's pretty obvious to us that you have to disabuse notions of cash flow generation for land valuation. You cannot value a patch of land on the Sheikh Zayed Road in Dubai by looking at how much money people are prepared to pay to park their cars there. It simply won't work. This is not the only form of property which is not suitable for discounted cash flow valuation. Historic buildings and others are in the same category, but I think we can fairly well dismiss cash flows as a valuation mechanism for land. Where does this put us then? Where do we go next? Well, traditionally the next place to go, the next best method, according to the Royal Institute of Chartered Surveyors, and I would completely agree with them, is to go for comparables. And that's where we are. And I'm almost sorry not to be able to display at this point some magic method of land valuation. I'll give you at least one possibility a little bit later on, but there's no real magic method. There's no gold standard that comes up. What there is an awful lot of hard slog in obtaining information on comparables. And we shouldn't really be afraid of talking about comparables as a method for valuation. After all, the world's stock markets revolve around comparables. And all valuations in stock markets are essentially price-earnings multiples, PE multiples. Now, with land, we can't go for PE because we don't have the earnings, not reliably. So we have to go directly to meters squared and the value of the land on the basis of deals. Now, bear with me on the idea for a minute that we do have, for what we're trying to work from, deals or comparables, which are actually transactions. We may need to spread our wings quite wide so far as deals are concerned, and look at international comparables, and with globalization and a whole lot of other stuff, I think we can reasonably look at international comparables even for land around here, although there are some parts of this region which are pretty much incomparable. Mecca comes to mind, for example, where you're very hard-pressed to find any valuation of land which is even remotely comparable to being able to value in the areas of that holy city. And demand and supply there is so exceptional that it's very difficult to get other comparables. But in general, I think any land valuer in this region ought to pay close attention to international comparables on land. And so if you're in Dubai, you should be paying comparable attention to cities that are comparable with Dubai, whether they be KL or Singapore or London, Paris, and so forth. So the next step from your direct comparables is to accept that your patch of land, and we've already mentioned the qualitative aspects of the land itself, your particular patch of land is not likely to be the same as the deals that you've found. And there are two methods that you can use, or should be used, to deal with the problem that the land that you have found, in terms of its deals and purchase, won't match the land that you are trying to value. Now, the most obvious way in which the land is not going to match is that it's going to be a different size. Now, that's not difficult to work out, is it? If the land that you've got as a comparable is twice the size of the land you're trying to value, then obviously you're going to cut the price in half to compare with the land that you're looking at. That really is very straightforward. But there are many other issues in the land that will not be so easy to adjust: the topography, the location, and so forth. Mention of location, particularly, is difficult. Imagine that we have a city and you divide it into 4 sections. I don't really mind whether you divide it crossways or whether you divide it in a straightforward square. But imagine you've got 4 divisions in your city, just for the sake of the model: north, south, east, and west, let's say. So picture a cross grid, and you have a quarter of the cake north and a quarter of the cake west, a quarter east and a quarter south. Now imagine that you have land in the middle of each of those quarter cake-shaped pieces. Now clearly, land in those individual locations is very well and truly in that particular sector. So if we have land in the middle of the south sector, we can very much say this is southern land. Similarly with eastern, northern, western, and so forth. But if you take land at the center of that process, right at the center of the grid, the land only has to move a very short distance before it changes its sector, doesn't it? It can be north, and then if you change sector a very short distance, you tip into south, or you tip into east, or you tip into west. So land that is at the boundary of any given region or sector poses us an intrinsic problem so far as its aspects of the land are concerned. Now what chartered surveyors do, what they tend to do, is a relatively crude process called a land adjustment grid. So they take land and they say, here's land in the most basic place, right? We're going to add 10% if it's close to the center of town. We're going to take away 20% if it doesn't have utilities attached to it. We're going to add 10% if it's close to an airport, and so on and so forth. And so you start with 100 and you go 1.1 and then you go 0.9 and you go 0.85 and so forth. And you end up with a valuation for your individual land. Now a land adjustment grid, and let me be quite brutal about this, strikes me as evidence that the chartered surveyor really doesn't understand how to do econometrics and is not really gripping the problem in the correct sort of way. If you go online and search around under hedonic valuation methods, you'll find a great swathe of academic research. And I'm not usually a great supporter of the academics, but in this particular case, I think I'll stick up for them. You'll find a great swathe of research which actually points out how this whole process is actually supposed to be done. Suppose, and in fact you can, if you want to have a look, the most extraordinary of places, there's a beautiful example about how to do a hedonic valuation of a building on Excel in the help section, on how to do a regression model on Excel in the Excel help section. But on land prices, if you imagine the land prices that you've got on deals, you say that your land has certain qualities, location, size, all the rest of it. And as we said, size might not be a linear factor and so on. You score each of the individual deals, and then rather than putting weights in manually yourself, as you do with the land adjustment grid method, you put this into software. Excel will do it, although Excel is not really built to do regression. You can use a more complicated package like Starter or SPSS, or you can use a standard method, something like Forecast Pro or Smart Forecast or something, but a decent piece of econometric software, and you don't get round valuing land without doing econometrics. Sorry, you just don't. You can't go about doing a proper land valuation unless you understand how to do regression analysis. It's not the most difficult thing to do in the world, but you really have to understand how to do it. And the reason you have to understand how to do it is that once you know how to do a regression, you can work out what the influence is of any given variable on the land value. Location, timing, obviously is one issue. If a deal is a long time ago, then that's going to have less of an influence on its price, and so on and so forth. And armed with that, you end up with different factors, different regression inputs into the process. And then when you know where your target land is, and you know how big your land is, and you know what qualitative characteristics your land has, and you know all the other key drivers of the valuation of the land, and you'll know that because the regression analysis will tell you your R squared, and if your R squared is not very high, then you haven't captured all the drivers of what's actually driving the land valuation. You better go looking for another one, and maybe something you've missed about the land. It's planning permission issues or anything else. So when you've got that, you put those, you know what the values of the regression inputs are for your land, you put those in, you press go, and the software will tell you what the valuation of the land is. And I've done this in practice and gone back and analyzed these things using regression analysis, and I can tell you the market is smart. the market does actually implicitly, and in some cases explicitly, actually take into account these different factors for land. And land pricing is a very close, sophisticated process that is not crude and does take into account all the characteristics of the land that actually differ. Now, at this point, many people in this region in particular will come back and say, well, that's fine. You can do that in a market which is free and a market which has plentiful transactions on land. How do you go about doing this in a market that doesn't have such frequent transactions? And I give you two possible ways through this. And neither of them is perfect, but let's remember what we're trying to get to. In the end, we're trying to get something that works. And by works, I mean is credible with the bank, is credible with investors, believable with both of those parties, and not necessarily something which has to be backed up with actual transactions to work. It is always better. It enables you to sleep safely at night if you know that you are valuing land at 100 if you had a transaction yesterday that showed that land was transacting of a similar type at 100. But if you don't have that, the next best thing, and I say this with some hesitation and some reluctance, but it has to be said, is that you fall back on previous valuations. And you do the same process, but instead of based on transactions, you actually use valuations. Now, there are all sorts of problems with using valuations as the basis for a valuation. And I'm sure all of you will see the bootstrap problem. If you see a trend, then what will happen is that if you use previous valuations, what will happen is that the valuation regression process will simply extrapolate previous trends. And so if the trend has been to increase land price, what will happen is your valuation-based transactions price will end up with a higher land valuation on the same trajectory. And that's what's actually happened. And of course, in many cases, what this results in eventually is a hideous crash where the emperor is revealed to have no clothes. The absence of purchasers produces a realization, a sudden realization, that the land prices that have been inputted are not correct, that there are no real buyers out there who are willing to pay these amounts of money, and as a result of that, a precipitous decline in land valuations is caused. And I'm afraid we have to wear that. The only solution to the problem is to be relatively conservative, to keep land valuations modest, and to recognize that if you are using valuations as a basis to do your regression analysis rather than actual transactions, you need to put perhaps liquidity element in there and a discount for liquidity, which may result in the valuation that you use being somewhat more conservative than the valuation that gets driven from your regression model. What it doesn't excuse is simply standing back from the exercise and saying, I'm not prepared to do the exercise at all. And it doesn't excuse not looking at international comparables, which may well be a very appropriate method for looking at the individual land cases, even when sales are relatively infrequent. Nor does it justify reverting to the old reversion method when, in fact, you still have very high land prices, which we know actually exist. So that's how to grip the problem. I know it's not a completely adequate solution to it. It's not as if it's enormously satisfying. It's worth adding to this that we have a possibility of using another method which is worth investigating, and that is that you can conceivably use a real option approach to the land valuation, which is an extension from discounted cash flow. By all means, look up the extensive discussion online about how real options work. But all real options do in relation to land valuation is that they are extrapolating future value and bringing it back to the present on a probabilistic basis. So the residual method is well suited to approaching from a real options point of view, and even other methods such as DCF and so forth will work. But all a real option method is doing essentially is saying that the current value of the land may be X, but if you were, for example, the best example of a real option valuation of land is on planning permission. If planning permission were obtained on the land, it would automatically rise to 10x. What is its value now? Not X, which it would be if there was absolutely no possibility of obtaining planning permission, but in fact 5x or 6x, because we are actually going to discount some probability that we will actually get the planning permission obtained on the land going forward. Now, real options are a very trepidatious and dangerous approach to land valuation because they are, of course, more or less literally counting your chickens before they're hatched. You're taking value on board before you have a guarantee that you have that opportunity really there. But in many cases, Saudi Arabia is a very good example of this. It may well explain the way that land prices work, and it also explains, real options theory also goes some significant way to explaining why land prices are more volatile than the underlying property which is built on them, because when markets are going up, people are anticipating future value, and when markets start to go down, all that options value suddenly goes out of the window. And it's very similar, actually, to the tech price crash. Exactly the same process happened when tech markets crashed at the end of the 1990s, and people realized there that many of these tech companies did not actually have the opportunities that they believed they had. And that's why prices of companies like Amazon and Oracle, a number of others, fell during that period. And that's pretty much the same reason why, for example, my favorite example of land price real options theory, Jordanian desert, which rose by hundreds and hundreds of % during the early parts of the real estate boom in the 2000 era, and then collapsed exceptionally suddenly when people realized that in fact many of these development opportunities were not going to happen, and that the land really wasn't going to deliver that development promise which people thought that it previously had. So valuers, when there is no liquidity, look back to historic deals and project. They also look to indices in other countries and other places. And anybody who is seriously interested in valuation certainly ought to keep a very close watch on and an interest in land price indices and how they are produced. And land price indices are produced, for example, I mean, let's take the UK as an example, and there are plenty of land price indices used in the United States by states for valuation purposes and elsewhere in the world, and the IPD in particular is very keen to start spreading land price indices as far as it possibly can. Savills is another organization which tracks valuation of land, and I've just quoted something from the Savills index, I think, and they say here, as you can see, that English farmland rose by 4%, and it's now over 10,000 per acre, which doesn't sound very much, but you've got an awful lot of farms, an awful lot of acreage that you're considering about valuing. And you can see here that equipped land, infrastructure land, rose by a less percentage. And of course, we've seen over the past 10, 15 years, what we've seen is that there's been a very steady rise in land prices, and that in fact, had you invested in UK land around 1990 or 1995, you would have outperformed not only the property market but the stock market as well. So land has been an exceptionally good investment for everybody. The problem with investing in land as a general rule is that precisely because land doesn't generate that cash flow, it becomes very difficult to invest in the land using debt, because debt investments, of course, require the cash flow, so investments in land of necessity have to be equity investments. And in fact, we've seen a number of scandals of companies being established to buy land in collective ownership, which have resulted in inadvertent contribution to ecological conservation, because the last land that any developer would want to buy is one owned by a multitude of individuals. But there you have some sort of indication about how the valuation of land has gone. And do remember that these indices, which are produced by IPD and Savills and so on, are based on a valuations process for the land, which in turn reaches back to the relatively few transactions that have taken place. My late parents' village, for example, no more than 100 acres has been transacted since somewhere around the year 1300. So if you think it's difficult to get transactions-based information on land transactions in Dubai, Abu Dhabi or Kuwait, then I assure you that rural English farmland is equally difficult to get transactions information on, because those transactions simply don't happen very quickly, very often, very frequently. Nevertheless, you can get these sorts of indices, which are always good benchmarks for comparison purposes. And we should have a look at the evidence here, which I think is the last slide that I've got to present here. And you can see the evidence on land prices is really quite interesting, because looking at here in terms of this, obviously there's one particular research organisation, and we're looking here at thousands of pounds per acre. And I thought it was a particularly interesting slide to show, because obviously we're going back to 2007, which you might consider that this was the recession, and you might think that there would be a fairly significant downturn in the value of land. But in fact what we see is that the recession, broadly operating from 2008 to 2010, all it does is in fact produce a relatively level land valuation index. Now, it may be that the index numbers that one gets to see are relatively smoothed by comparison to actual transactions. But precisely because land is very frequently purchased by equity, it is not so subject to the shortages of debt and the availability of debt finance, which are prevalent in a recessionary environment. And so if you compare that evidence with, for example, the evidence of the value of AAA property in London or speculative properties elsewhere in the location, you see that there is much more of a correlation with inflation than you would otherwise expect to see. Now, I'm not suggesting that urban development land in this part of the world would keep pace with inflation. It almost certainly exceeds it on an annual basis. But what I am suggesting is that you may well find a relatively stable trend in the valuation of land going forward, with the exception of the period from 2007 to 2010 that I'm not sure we can generalize about. And that may be of tremendous use to us in looking forward to analyzing the value of land in our development and our investment opportunities. I know I haven't solved all the problems in this presentation. I'm not sure that real estate investment or real estate development would be at all as exciting as it actually is if I could solve all those problems. And if there were not risks, then there would not be opportunity. But I am convinced that an understanding of land, an accurate valuation of land, and paying attention to the proper methodologies which are involved in the valuation of land is an essential ingredient of successful real estate development and investment in this region, and even more important going forward than it was during a period when land was going to be given free, which is decreasing. And even when land is given free, and I was talking to some people today who've had a great deal of land given to them by a government in this region, even then they are careful enough to ensure that the market value of land is always put explicitly into their feasibility studies, and I commend them for that. That is the right way to assess their performance, always by putting the most accurate market valuation of land that they can possibly get into all their feasibility studies and investment proposals. Well, thank you very much for your time. Much appreciated. You want me to have a look at some of those questions? Let's have a look at what's got said here. Ah, yes. Of course, the question about government and about the role of government and the commitment of government land. Government often uses the control of land that it has as a way of manipulating market prices, and there's very good examples of that throughout the region, of course. And it's absolutely right to say that the demand and supply for free land is a reflection of whatever supply is held back by government. So if government releases land into the open market in large quantities, and it would be foolhardy to do so all at once, then the consequence of that, as with any demand and supply exercise, is that land prices will be put down. Governments in this region are super aware of the consequences of offloading large quantities of land, and they have been extremely careful to ensure that they have put land in the right hands to ensure that development was kick-started originally by not charging for that land, and that they have then put land into the relevant organizations and drip-fed it into development so that they've made sure that they never get a swamping of the market with releasing large quantities of land for development. And it's certainly true that government goes even further than that to ensure that land is accurately installed. For example, I remember advising the Singapore government on the valuation of land where ESSO was proposing to create a refinery, and of course the effect of that was to increase the land valuation. Therefore, to cut a long story short, the amount of money that they should be charged as a license fee should be substantially reduced by the externalities of the increase in land value being retained by the government in the process. So governments certainly do that. Now, a question here about the pricing of the land in relation to the land department. The answer here, a fairly clear answer about this. As we've said, government will attempt to manipulate land prices and hold them up to certain values and so forth. Now, sometimes the market price of land is greater than that which is permitted by the land department, and sometimes it's lower than that by the land department. But in all cases, what really ought to be considered here is the market price. So certainly you shouldn't use the land department value during the analysis. You should always use the market price in an analysis yourself, even if you can't actually get the land off your hand under those circumstances. I would have to spend longer answering that in depth. My summary answer to that question is that you should definitely use the market prices. Oil prices and the effect on land in the region, Rami. A very good question. You can see if you look at the last slide that I presented that the UK economy was going through the most extraordinary transformation and effect. Unemployment was rising, GDP was falling, government debt was rising. The UK economy really went through a traumatic phase from 2007 to 2014, and of course we also had a substantial increase in oil prices during this, and you can see the effect on the land price was zip, nothing. My inclination is to say that except in very specific circumstances, such as oil development opportunities and specific valuations of refineries and land and so forth, we have got beyond the point where the oil price is going to have a significant impact on land valuation in this region. Real estate development here is now proceeding independently. If we were talking about the 1960s, the 1970s, yes, absolutely. The oil price is going to be a major determinant of that, but not now, I would say. Anyway, you're asking about the land process here. I hoped I tried to make clear that the residual method simply doesn't work very well. It's such a high percentage of the total, you're much better off using comparables and driving to the market valuation wherever you possibly can, with an eye out for the possibility that at any stage the government might decide to dump, as it has dumped a little bit of land in Kuwait, but might decide to dump more as a result of a political negotiation process, which would of course have a significant effect on the valuation. But in the absence of anything else, in the absence of any reasonable reason to think differently, always go for comparable sales, try to get as close to the market value as you possibly can. Does anybody else have any other questions? I know I'm running out of time here. We could talk about this all night.
Thank you, Julian. That was really, really informative. I think the last 45 minutes I've been here, I've been listening to. We've got a lot of questions coming in, and we've got a lot of attendees. Just a little note that I realized that there was a bit of a technical snag in the beginning, and the first 2 or 3 minutes you were not able to hear the presentation that I was doing in terms of my opening. I'll quickly take you through the housekeeping rules, which were basically that we will be sharing these slides on a slide share page, and the link will be emailed to you in the next couple of days. The recording of the webinar will also be made available to download, and the link will be emailed to you in the next couple of days. There will be a pop-up that will come once we end the webinar. That will be a little survey, and we will really like all attendees to please fill that survey and send us your response, how your experience was with the webinars that Winforma has been doing for the last couple of months. I know questions have been coming across, and we have allocated enough time, but if you have any questions that you would like to ask after the webinar is over, you can always write to us as well. So I hope that session was quite informative, and on that note, I'd like to say thank you to all our attendees from myself and from Julian's side, and I hope you have a lovely evening, and I hope you sign up for another or all other webinars I'll be hosting in the next couple of weeks and months soon. So thank you, enjoy your evening, and thanks so much.